If I am investing totally in socially responsible funds versus none, am I going to achieve a higher rate of return or lower?
If I knew the answer to that, I'd be a rich man. The answer is maybe. I mean, the idea of socially responsible funds is this is not charity, right? Impact investing tilts a little more towards you're trying to do good and returns are a secondary consideration. ESG, you want to make money, and the idea is that you'll get higher returns, and here's why. The idea is that either you're overweighting companies that are contributing to what the future will look like. So call it like wind power or something like that, right? A clean tech, right? Alternatively, you might be trying to avoid landmines. And the best example here is an energy company, right? Like British Petroleum, Deepwater Horizon, spills oil in the Gulf, stock gets cut in half. The idea is with ESG screens, you compare companies to their peers and you reduce your weighting to or eliminate companies that might be more prone to step in it. And thereby you avoid large losses, you get better returns. That's the theory at any rate.
It sounds pretty good.
It sounds really good, right?
But what's the problems? What are you seeing? I mean, you screened a bunch of ESG and socially responsible funds and so on and so forth. I mean, what issues do we have here?
Well, the biggest one, first of all, is that nobody really knows if everything I just said is going to come to fruition, right? It's a relatively new space. So we can say, like, yeah, in concept, it seems like those companies should do better. And over any short period of time, maybe they have. Who knows what the future holds, right? So that's one. But I think the second is that the idea of ESG is that you're layering on your social views to investing. We're all individuals, right? We have an election coming up so we can see what the world looks like and all the differing opinions, right? Everybody doesn't think the same way, so you've got to go find funds that A, share your views, right? That could be tough. But then B is that are good investments, right? And now you're doing screens around what's the cost of it, right? Just like the true false question, what's the investment approach, who's the manager and stuff like that. And so then that takes some expertise to find the best funds as well as funds that reflect your views.
Yeah, and I think there's now micro funds, right, to certain causes. You can get really granular, and then instead of having, a broad-based portfolio is going to give you 12,000 stocks or 15,000 names, right? So if one company goes under, you're still going to be protected. But if I get really granular and just say, I want this tiny specific area of the market, you could be taking your universe to a very small town, for lack of a better
analogy.
Thank you.
That's why I'm the research guy, right? The words, I looked it up. Right. No, yeah, you're absolutely right. So one of the big benefits of investing is diversification is essentially a free lunch, right? And if you narrow down your window, A, you might find that you're concentrated in certain sectors, right? So if you're really environmentally conscious, you're probably not going to hold a lot of energy companies, right? What if you're in an environment where those are doing the best? Now, if your personal views are more important than portfolio returns to you, that's not an issue. But if your number one concern is getting good returns, that could come into play. But the other thing is just when you look under the hood, what are the odds that if you build a fund, it's going to hold exactly the vehicles and the views that you have, right?
Impossible.
Almost impossible, right? There might be things you love and then something you're passionate about that it doesn't own.
Go to yourmoneyyourwealth.com and click on our special offer. It's pursuing a better investment experience.